don't be fooled by the headline rally you saw in the Korean market. Underneath it, there was a massive 827.2 billion won foreign capital extraction, and that signals a structural risk-off position for the US Open, right before CPI. All right, let's get one thing straight. The big move for the Nasdaq tonight, it didn't just start. The signal was locked and the capital was positioned a full 12 hours ago, right at the Asian market close. It's already done. So on the surface, everything looked incredible, right? The KSPI index rallies a strong 1.40%. You see that and you think, okay, clear risk-on signal. But you'd be dead wrong. And this right here, this illustrates the whole conflict perfectly. On one side, you've got these big green candles, the index just pushing higher and higher. But on the other side, what was really happening under the hood was a massive withdrawal of capital. The price action was basically a lie. Now, let's talk about the scale here because it's just staggering. We're looking at a net 827.2 billion won in non-arbitrage program selling. You got to understand, this isn't just market noise. This is a huge directional decision by major global funds to get out, period. So the real story isn't in that big, shiny index number. No, it's hidden in the moves made on the most critical supply chain nodes. To find the signal, we had to activate the Canary protocol. And here it is, Samsung Electronics, our canary in the coal mine. Look at this. The stock closed up over 1%. Super bullish, right? But at the exact same time, it was the single most shorted stock on the entire market, with almost 193 billion won in short selling volume. That's a classic divergence. It tells you that sophisticated capital was using that price pop to quietly build massive new short positions. And this brings us to the billion-dollar question, doesn't it? Why on earth would the smartest money in the room be dumping their positions with such surgical precision right when the market looks like it's about to blast off? The answer is just brilliant, really. It's hidden in the market's own plumbing. See, they didn't just sell. They used a very specific mechanism to pull their capital out without causing a panic. They literally weaponized an artificial price floor. That mechanism is called contango. Put simply, it's when the futures market is trading way higher than the actual cash market. And that price gap, it creates this powerful magnet for arbitrage buyers to jump in and buy the cash index, which in turn props up the price. And here is the exact four-step playbook they ran. 1. The futures premium got wider. 2. This sucked in all the institutional buyers looking to grab that easy, risk-free spread. 3. And right into that wave of buying pressure, the global funds dumped their massive basket sales, using it as a perfect exit door. And 4, the result? They turned all their stock into cash, while the index actually went up. It was a flawless extraction. So, okay, we know how they did it, but why? Why the sudden rush for the exits? The answer is a huge macro event that was just over the horizon for the US markets. Just look at this timeline. The huge liquidity extraction happens right here, at the Korean close. Then, exactly 12 hours later, what happens? The US CPI inflation data drops. This was absolutely not random selling. This was a deliberate, preemptive move to de-risk before a major catalyst. The signal for the US Open was locked right then and there. So here's the tug of war we're left with. You've got the price signal screaming bull with a 1.4% rally. But the capital flow signal, the smart money, is screaming bear with that massive outflow. And that conflict, that's what's going to decide the entire US Open. All right, analysis complete. We have the signal. Now we switch from analysis to action. This is the battle plan. Remember the number one rule. Do not trade the headline. You trade the supply chains. Here is the framework. For the bull case to have any chance, Nasdaq futures must hold above 24,780. The bear case, our primary thesis, is confirmed if we break below the key pivot of 24,200. A break there validates the entire Asian liquidity exit. First directive, watch NQ futures pre-market volume. See if it aligns with the selling pressure we anticipate. Second, know your invalidation level. The bear case is off the table if price reclaims and holds above 24,780. Third, this is the trigger. Confirm the bear case on a decisive break below 24,200.
Finally, your timing. Execute only on a clean 15-minute candle close below our level. No jump starts.
Final check. The asset is NQ, NASDAQ 100 futures. Confirm the signal with volume. If the pre-market action contradicts our entire thesis, we stand down. Your number one job is capital preservation.
We log the results at 0630 EST. No exceptions. The signal from the Asia close dictates the New York Open. If you want that edge, you know what to do.